Hey, good morning, everybody. It's Hammer. Today is Thursday, October 3rd, 2024. I, of course, with Originator Success here with your daily mortgage rate update, the only place on the web where you can join me live each and every day at 9:30 a.m. Eastern Time, or maybe a few minutes late when the nightstand alarm clock in the hotel, which I was using for time, I just realized looking at my computer is about 6 minutes behind. So I'm sorry, y'all. I'm late, and I didn't even mean I was on time and still late. How does that happen? So anyway, thank you for joining me. Appreciate you being here. Remember, you can join me live each and every day. If you're watching on the replay, don't forget to give me a hashtag replay in the comments. Let me know that you were here. Don't forget to smash that like button, tag an hello friend, share the post in a group. Let's go ahead and say hi to the live folks as everyone is trickling in. We got Mr. Tim Kyla here this morning. Good morning, Mr. Tim Kyla. Let me break this light down here so I'm not so washed out. That's a little better. Oh, and let me turn on. There we are. Turn on a little backlight here. We got to change the studio conditions. This is my last day here in Austin. I'm flying home this morning, and then we'll be doing some cleanup. I'm going to be stopping and getting some supplies from as I go from Atlanta up to home. And the wife's been passing out a lot of our stuff, which is totally awesome. But she said I need to rebuild and restock our pantry and our freezer and everything else. So, but if you have, you share, right? That's what we do. That's what we do in America. We are good people. So, um, anyway, good morning, Mr. Tim Klyla, Nicole Semerad, Deb Dickinson, Amy Blauser. Good morning. Megan Lindberg, great to see you here as well. Angela Walters, Dan Crowley, Mike Love, good morning, all. Appreciate all of you here. Thank you for joining me. And there you go. So I'm going to jump in. Let me change my little chat here. Let me change the caption and get rid of this. Let's go ahead. I'm going to flip over to here. And I'm actually going to get rid of that at the bottom. I don't want that up there right now. We're going to share the screen. Let's talk about what we got going on this morning, what's been going on the last couple of days with rates and pricing and stuff. So first things first, let's talk about trends. So when we look at these mortgage-backed securities, we're looking at all these fancy candlesticks. Now we can look at each individual candlestick, which is a trading session or a day, right? And then we step back and we look at this big picture. Like right now, we're looking at a 3-month um, chart showing all of the days in the last 3 months, right? So we look for these upticks when we see these green candlesticks and we see these lines moving higher. That means that you've seen better rates and pricing. When we see it move lower, it means rates and pricing are worsening. So, for example, the best that we saw here, this peak, it's a little mountain peak as we ride this wave up, was back around Monday, September 16th. And if we take a look at Mortgage News Daily, use that as a reference point, right here around the 16th and 17th, you'll see that corresponds and correlates to some of the best rate sheet pricing. So 6.12, 6.11. Now, Matt Graham does an aggregate of pricing here. So, of course, this is like kind of a rebate pricing type scenario, no loan level price adjustments or things like that. What makes it so valuable is he is consistent. So it may not be your rate sheet, but it's what we're seeing on rate sheets, right? This is kind of consistent here. So back at the 16th, 17th, we saw some of the best pricing there. If we take a look here at mortgage-backed securities, they were at that highest level. Hold on, I want to get rid of that stupid little, there you go. So back up here, see these peaks? Now, since then, we have been moving lower. Now, of course, if y'all remember here on, and I clicked it again, my bad, here on September 18th, that was I just got to do this. That was the Fed meeting. Since the Fed meeting, right here, we have seen mortgage-backed securities lose ground. Now, we actually improved a little bit, then we lost ground a little bit, then we were flat, then we come back up to be, basically flat right here for about a week after. Then we started to lose a little ground, then it jumped back up again. Then we dropped, then we jumped, and then the last couple of days we've dropped. Now, overall, you could see there's been a bit of a trend that we're just losing ground. Now, I expected to see a bit of a rebound. We were looking at the technical support level. So this blue line is a 25-day moving average. And you could see that it kind of looks like these candlesticks, they come down and they bounce off of that. That is because that is how the technicals work. And that's exactly what we call it. We call it a bounce. Now, yesterday, we broke below the 25-day moving average, and today we remain below it. So this is actually a bad sign. This would put us in a position where we're more likely to lock because we have room to move lower before we hit more support. We have this 50-day moving average, and we could draw some lines based on past candlestick performance and give you some other levels as well. But the technicals are going to take a back seat, and I'm going to flip over to the other screen again. And Here we go. Okay. So the technicals are going to take a back seat though, because what do we have going on tomorrow? Drum roll. We got the BLS jobs data. Now, I got to tell you, I don't have a super warm, fuzzy feeling heading into tomorrow's jobs data. We have to assess risk. Today is the day. Yesterday was a day where we talked about assessing risk in your loans. And, generally it's the loans that are closing more near term. I said before the Fed meeting and I said after the Fed meeting, we're going to see rates move lower. And yet rates have not moved lower. Hammer, you're a damn liar. I get that. I know you're probably mad at me. Yeah, I'm not mad at myself because we're really not that much worse. But what I will say is they are going to move lower. It's just when. It's not if, but when. Problem is, loans don't wait forever, right? So you got to be deciding, okay, where do we go? Now, also, you may have quoted a rate and then rates got a little bit higher, and you're like, oh, so you're chasing rate. You don't want it to get worse. I feel your pain. I tend to do that myself sometimes. More so now that I counsel y'all and we talk about it every day than when I actually did loans. When I did loans, I was really good at just saying to someone, hey, listen, they've moved. This is what you've got. And let's run with it, right? Kind of a thing. So now, what could happen tomorrow and what does this all look like? So tomorrow we're going to get the BLS jobs data. That jobs data may or may not help us. What do we have to see this jobs data help us? Well, it's got to really come in showing weakness. It has to reaffirm for markets that the Fed is going to need to be worried about protecting the labor market. Now, let's go back to sharing the screen for a minute and let's talk about a couple of things. Right here are Fed futures, right? CME Group Fed futures. We have seen that right here on the right-hand side column. This is the expectation, the probability. It's the rate probability for the November 7th, 2024 Fed meeting. So it's the meeting. It's going to come up in about a month. We got about a month now. And right now, the expectation, we are at 4.75. The expectation is we will see a quarter point rate cut, and it'll bring us to 4.5. There's an outlier expectation that we would be see a half a point rate cut and go to 4.25. Now, Fed Chair Jerome Powell the other day really sounded like he was trying to temper expectations for markets. And he said, we're not going to lower rates too quickly. We have time. We're going to do this at a slower pace. So he kind of signaled to markets they're looking at a quarter point hike. And that's 2-to-1, kind of what markets are buying into. Now, if this jobs data were to come in and it was stronger than what is expected, and it doesn't make everyone feel warm and fuzzy that the job market is in trouble, we're going to see this column is going to go down, this column is going to go up, and mortgage rates are going to creep higher. Now, I know, again, we've seen very slow creep, and I've warned you, that's what we're going to see. We saw 6.11. That was our low point. Then we were at 6.15, 0.17, back to 0.15, jumped to 0.20. This was 9.23. This is 2 weeks ago, right? And that I'd have to look at a calendar, but it seems like it's about a week and a half ago. Then we got 6.18, got a little better, 6.19, 6.21, right? So we're still right back there in that realm. Then back to 6.20, which we saw here on 9.23, 6.20. And we've even seen that before in the month back down here when we had higher rates. Now we're at 6.24. Drop back to 6.20, 6.25 yesterday. We got it. Mortgage rates got hit a little bit yesterday. Damn it. That hurts, right? You see the rebate pricing. You're like, oh man, why am I floating? And it really, again, you have to keep a perspective on this. And it depends on how much time you have to work with and, how risk averse the loan is. So we've seen rates creeping higher. We certainly can't argue 6.25 is higher than 6 1/8. And that's 1/8 of a point in rate, though. That's really all the movement that you should have seen on rate sheets. If you've seen more dramatic movement, something is wrong. Yes, having points move 1/8 of a point higher is not fun, but let's remember something. First of all, when it comes to having the conversation with people about rate, and I don't want to get too far into this, it's already 9-10 minutes in. But when you're having a conversation about rate, it's a lot easier when the rate goes up 1/8 of a point and the payment moves a little than if the rebate moves and their closing costs have gone up thousands. There is a mental piece here. Let me know in the comments. Do you agree or disagree? Just say agree or disagree. You can say more if you're on your computer and you want to type. But if you're on your phone, either an emoji thumbs up or an emoji thumbs down is good. Thumbs up if you agree. Thumbs down if you disagree. Type in agree or disagree. There are 34 people on here. Do not be lazy on me. I want to see 10 or 15 responses at least. Let me know if you agree or disagree, right? rebate pricing, the jump in rebate pricing, when people have to bring more to the table, they tend to get more upset about that than if it moves an eighth of a point. An eighth of a point in rate is not a big deal. So keep this in mind when you're quoting. And sometimes if you see rebate pricing, maybe jump the eighth and you'll actually be in a better scenario. So anyway, talking about all this, what could happen tomorrow? And I see Rock agrees. What's up, Rock? Megan Lindberg says yes, increasing closing costs is worse. Tim agrees. Thank you guys for waking up this morning. Mike agrees. Deb Dickinson said it depends. Ashley says agree. Angela agrees. Chris agrees. Monica agrees. So and it's funny, Deb, you're kind of walking that line. You're hedging your bets on this one. So anyway, my point here is that the rates have crept a little bit higher. And that's not the direction I said they'd go. And it's not the direction I thought they'd be by now. I thought the dust was settled. And I thought we'd see things improve from here. We have not. What has been the real reason for it? There's not a lot of reason. It's just that, I guess those people that said that it was already priced in, yes, they were right, and they've been right the whole time. It was already priced in. It's the future is cloudy. That's why we haven't seen the movement. The future is cloudy. Markets don't know, is the Fed going to be forced to cut rates because the conditions, the data tell them that they need to, or are they going to be sitting on this and are we going to be floating? Now, the one thing I really want to emphasize, seeing rates move an eighth of a point higher does not freak me out. It freaks out a lot of LOs these days, but it does not freak me out. Rates moving an eighth, even a quarter point higher, this is the ebb and flow of mortgage rates. We are not in an environment where rates are going to creep back up to 7. Okay. We're still in an environment where rates will stay in the vicinity they're at now. And when we anticipate we're going to see more rate cuts, the economy is slowing down, the labor market is softening, we'll see that move lower. Well, what about the dock worker strike? Well, first of all, I don't want to get too far in there, but I do not support the dock workers on this one. But you're going to see it have like a lot of headline effect. You're going to see it affect some stocks, but it's not real inflation. It's not something that's going to hit bonds. Do you know how long it would take for the things that don't come in? They don't immediately raise prices at the grocery store because there's less bananas coming in on the boat. You don't see that, right? That's not how it works. It would have to be over time. What will happen is people will eat less bananas. People will eat other things. There's lots of other stuff that's going to come in that isn't going to be affected. The things that are affected in cars and different things, they're inconveniences, but car prices are not going to go up. People are not going to have a shortage of cars. You're not going to not be able to buy a new car, not be able to get to work unless you pay more and get other. That's how inflation works. So they talk about all this stuff like there's just this immediate effect, blah, blah, blah. There's going to be inflation. No, there's not real inflation. And this could drag on for 6 weeks, 2 months. It's going to be an inconvenience. You may see it affect some things a little bit, but it's not going to you're not going to see it there. And then when would you actually see it on the data? Months from now. You're not going to see it tomorrow, right? You can see it months from now. So keep that in mind with all of that stuff. So anyway, tomorrow, BLS jobs data, it's a big day. We could see, I am looking for a reversal. Let me go back to the other screens. I am looking for a damn reversal on these bonds. We keep losing ground and then almost coming back, losing ground and then almost coming back, losing ground. Well, we're only going to lose ground so far. But that's the thing. Is the bottom going to be here at the red line, 100.88? That's 30 basis points lower than where we're at now. That's an eighth of a point in rate. So yes, tomorrow we could see mortgage rates go up, and it'll take a while for them to come back down. So, as far as lock advice goes, you have to absolutely decide what loans can handle the risk. How much risk are you willing to take? I'm trying to get that. There you go. Get that backwash out of there. How much risk are you willing to take and where do you want to be? So rates in the near term, next week we're going to have CPI inflation data. That's not going to be a huge one because markets are looking at labor data, not inflation data, because the Fed is looking at labor data, not inflation data. So that's kind of where we're at. I mean, it really does hinge tomorrow. If the data is weak, we could see bonds rally finally. How much will it improve? Not much. We'll just kind of get back to where we were. Probably if I were to use Mortgage News Daily, right now we're at 6.25. Today we're going to be a little bit worse because bonds are down 10 basis points. So we'd get back to 6.15. I mean, it's you're not seeing great improvements. So if you want to lock things, lock them. Loans that have a lot of time, though, loans that get to that next Fed meeting, loans closing in November, I'm not in a hurry to lock those loans, y'all. I'm not. But if they're risk averse, if they like it, then lock the damn thing. What's the big deal? Deb said it's easier to sell lower costs and rates have come down, so it doesn't feel as bad, but payment is what many are looking at. So if it's the qualifying payment, it depends. I agree, Deb. I know that. I get the qualifying payment. Hopefully nobody's that close, though, to qualifying. Good morning, Ray Stevens. Good morning, Mike Tebow's late. Don't worry, I was late too, my friend. Chris Dickerson said we will be without toilet paper. Possibly. So, I mean, again, I'm up in Western North Carolina. I haven't shown you all the damage, and I'm here in Austin, but I'm there. They're without a lot of things, so I'll be bringing some stuff home anyway. Especially when the cash crosses a major threshold. I missed that comment. Let me find it here. Yeah, moving from like 9,600 to 10,000. I agree, Michael. You're definitely right on that one. So, again, Antonio, I did just kind of talk about that. I'll hit it one more time. How does the post strike affect rates? Right now, it's not really affecting them at all. Again, it's so easy when bonds move for someone to be like, well, that's because of this. Like, oh, we had a flight to safety because of Iran and Israel and that whole thing. But did we really? Bonds rallied like 12 or 15 basis points. That's not a flight to safety. A flight to safety is when a ton of money goes into bonds and stocks are down because people are afraid that the shit is hitting the fan. That something major is going to happen. That didn't happen. It was never really a real flight to safety. We saw some improvement. So there's always an argument of having an effect. But like I said before, there's not going to be much of an effect. It's more headlines than reality because we're not going to see it be palpable, tangible data, inflation until months from now. And it would have to be a long-term thing. The Fed isn't looking at it and saying, okay, we need to factor this in as an issue. Maybe what the Fed would do is say, well, inflation's not coming down as quickly as we anticipated. We feel that it could be transitory because of blah, blah, blah. That's all they're going to do. And again, inflation is not what the Fed is most worried about now. It's back to the labor market. They have a dual mandate. They have price stability, which is inflation, and they have labor market maximizing employment. And they know that by holding rates and pushing everything where we're at, we're starting to see that slip. Now, the jolts came in, more job openings than what were expected this month, meaning if there's more job openings, there's less demand, more supply. That means a stronger labor market. The ADP report came in with more jobs created, private payroll than what was expected. That doesn't mean that the BLS job data will, but that jobs data not showing the weakness that everyone argues is there. And yet boots on the street, we've talked about there is labor market weakness. So anyway, y'all, I do have to go. I got to go catch my plane in a little bit. But thank you for joining me. Again, you got to assess risk today as it comes into it and decide, hey, especially if the loan is closing in the next couple of weeks and we do have a bad day tomorrow, it's gonna kick off another bounce in rates moving higher, maybe to 6.5. We could see that. It's certainly possible. So if you don't want that risk, you've got to assess what's the potential for reward. The potential for reward here, rates may go down another eighth. We may go back to where we were around the Fed meeting a couple weeks ago. But that's best case scenario. Worst case scenario, you could see rates jump, so you've got to decide, having that conversation with the consumers today and say, hey, what do we want to do? And loans that have more time, they will come back down. I know that I keep saying it, and I know that I look like I have egg on my face because it doesn't happen tomorrow. There's no reason to see it happen tomorrow. We've got to get closer to that November meeting. We have to see where the Fed is looking at cutting rates. And again, it's not going to be, I've always warned it, it's not going to be big moves lower anyway. So it's not a bad environment to lock some loans. I know we're not at the bottom anymore, but we're certainly a hell of a lot better than even when we started the month, right? Rates are better than where they started September. So, a month ago. So it's all perspective, right? It's all perspective. Someone is, everybody wants to get the bottom, but the bottom from September is not going to be the bottom for 2024. And the bottom for September may not even be the bottom in October. So, it's only a perception of a bottom at a certain time. Don't get wrapped up in that stuff. Don't let that bleed into your brain and get all worried about it. You got to be focused on writing loans, doing deals, helping people. Don't get worried. Don't let that infect you about being concerned that rates moved a little bit. So, anyway, there's my TED Talk for today. Thank you for joining me. Appreciate the 38 of you that are on here at the end. Let me know if you guys liked my message today. If you didn't like it, I want to know that too. You hammer your message sucked. But if you guys like the message, let me know. Monica, thank you for the safe travels wishes. I will travel safe. I'll tell the pilot. Monica said, make sure this plane lands, man or woman. Make sure this plane lands. Rock, yes, I will have a great flight. So thank you, Jessica Wells. Good to see you, my friend. All right, everybody, take care, and I'll see you guys tomorrow. Bye-bye.